As of 11:01 a.m. Eastern Time, November 14, 2025, Nvidia Corporation is trading at $188.195 per share. That's a gain of $1.33, or 0.71% on the day. But that simple green number hides the real story of this trading session. The stock opened significantly lower at $182.86, gapping down from yesterday's close at $186.86, and was looking weak, touching a low of $180.58. Since that morning dip, it has staged a powerful reversal, climbing almost $8 from its low to break into positive territory. This is the kind of volatile, whippy price action that defines a stock at a crossroads. We are just days away from their critical earnings report on November 19th, and this intraday battle shows you everything you need to know. The market is deeply conflicted. There is a massive gap between what everyone believes about this company and the uncomfortable realities lurking just beneath the surface. The common expectation, the story you'll hear everywhere, is that Nvidia stock is an unstoppable force. It's the undisputed king of artificial intelligence, the one company that provides the picks and shovels for the entire AI gold rush. The narrative is that earnings next week are just a formality, another step up. The consensus expectation is for earnings of $1.23 per share on revenue of a staggering $54.6 billion. Analysts are modeling the data center segment to come in around $48 billion, a 56% increase from a year ago. They see the gaming division, which was a drag for so long, finally showing a strong recovery, with estimates around $4.7 billion, up 43.7% year over year. Even professional visualization is expected to post a 39.7% gain. With numbers like those, the expectation is that the stock, which is already up significantly year to date, is just getting started. This is the story that has pulled in millions of retail traders and solidified its position as a core holding in every major fund. But here is the reality that disrupts that simple story. If the path forward is so clear, why are the people who run the company selling their own stock? Let's look at the insider trading activity. Over the past 90 days, we've seen a net negative activity of over $221 million. This includes significant pre-planned sales from top executives like Chief Financial Officer Colette Kress and yes, even CEO Jensen Huang. Now, insiders sell for many reasons: diversification, tax planning, but the timing is what matters. To see this volume of selling just weeks before a report that the public expects to be a blowout is a major point of tension. It's a disconnect. On top of that, major institutional holders have been trimming. SoftBank, one of the most visible large holders, has fully cashed out its position. While 13F filings show some funds, like ARK Investment Management, have been adding, others have been trimming or getting out entirely. The smart participants, it seems, are not as universally bullish as the public narrative would suggest. They are taking profits while the story still sounds perfect. This is the central conflict for anyone involved in online investing right now. You might be looking at your Robinhood app, seeing the green number, and thinking all is well. You might be using a SoFi Invest account for SoFi Active Investing and considering adding more. Perhaps you're with a major brokerage like Fidelity, looking at your Fidelity mutual funds or Fidelity ETFs and seeing Nvidia stock as the top holding. Many who prefer self-investing on platforms like the Interactive Brokers trading platform are watching this intraday volatility and getting nervous. Even those using automated investment help through services like Schwab Intelligent Portfolios are exposed, as this stock is a core component of almost every growth-oriented intelligent portfolio. The expectation is simple: AI is big, Nvidia wins. The reality is that the people closest to the business are reducing their exposure. So, what does this company actually do that makes it so critical? For anyone new to online investment, Nvidia began as a graphics card company. They built the graphics processing units, or GPUs, that made video games look realistic. But a few years ago, researchers discovered that the architecture of these chips, designed to perform thousands of simple calculations at the same time, parallel processing, to render graphics, was also perfect for training artificial intelligence models. Their CUDA software platform created a deep and sticky ecosystem that competitors couldn't break. This turned their data center division into the 800-pound gorilla of the tech world. Today, data center revenue, driven by flagship products like the H100 and the new Blackwell platform, absolutely dwarfs everything else. The gaming division is now a secondary, though still important, market. The professional visualization segment serves high-end workstations, and the automotive segment, long a sleeper, is finally gaining traction, as evidenced by a recent major partnership with Hyundai Motor Group to build an AI factory for robotics and autonomous driving. This brings us to the serious headwinds, the parts of the reality that the bullish expectation conveniently ignores. The first and most significant is China. The expectation is that Nvidia will sell its AI chips to everyone, everywhere. The reality is that the U.S. government has explicitly forbidden Nvidia from selling its most advanced chips, including the new Blackwell line, to China. This is not a small problem. One Nvidia executive recently warned that half of the world's computer engineers are in China. Cutting off that market is a massive blow. Analysts are now modeling that Nvidia's AI chip market share in China will collapse from 66% in 2024 to just 54% in 2025, as domestic Chinese competitors like Huawei rush to fill the void. This is a multi-billion-dollar hole that the company must fill elsewhere, and it's a topic that will certainly dominate the earnings call. The second headwind is competition, not just from rivals, but from customers. The expectation is that Nvidia has a permanent monopoly. The reality is that Nvidia's biggest customers, Google, Amazon, Microsoft, and Meta, are all actively designing their own custom AI silicon. Google has its Ironwood TPUs, Amazon has Trainium and Inferentia, and Microsoft has its own projects. Why? Because they're spending tens of billions of dollars on Nvidia's chips, and that kind of expense is unsustainable. They need to control their own destiny and optimize chips for their specific workloads, especially for inference, running AI models, which is less computationally demanding than training, building them. While Nvidia still dominates training, this in-house competition is a direct threat to their long-term growth, and, more importantly, their sky-high profit margins. And this doesn't even count the traditional rivals. AMD is becoming much more competitive with its MI300X and upcoming MI350X, and Intel's Gaudi 3 is also fighting for a piece of the market. The monopoly is, in reality, a very extensive arms race. This is the core of the investment dilemma. We have a confirmed $1 trillion market opportunity for data center infrastructure by 2030, a massive tailwind. We have a company, Nvidia, that is the clear leader with the best technology. But we also have significant insider selling, a complete cutoff from the massive Chinese market, and a customer base that is actively trying to design them out of the equation. This is why the stock is swinging wildly today. The bulls are buying the $1 trillion story. The bears are selling the China and competition reality. It all comes down to the earnings report on November 19th. This leads to the big question for everyone, from the self-investing individual to the professional manager at Fidelity Wealth Management. Which narrative wins? Do these headwinds, China, in-house competition, and those insider sales finally start to matter? Or will the sheer overwhelming force of the data center build-out and the Blackwell ramp-up simply crush all those concerns? I want to know what you think. Comment below with your honest price target for Nvidia 1 year from now. Do you see it pushing past $220, or do you think the headwinds will drag it back towards $150? Here are the two scenarios we must watch for. In the first, bullish scenario, reality exceeds expectation. Nvidia reports the $54.6 billion in revenue, but more importantly, it guides higher for the next quarter. Management explains that demand for Blackwell is so enormous with a massive backlog that the loss of the high-end China market is already backfilled by demand from the US and Europe. They show that margins are holding firm. In this case, the stock breaks out of this $180 to $190 channel and makes a run for its 52-week high of $212. The bull case is confirmed, and the insider selling will be dismissed as simple diversification. In the second, bearish scenario, reality bites. Nvidia might meet the 123 EPS, but the guidance is weak. Management is forced to quantify the full impact of the China export ban, and the number is uglier than expected. They might mention that gross margins are seeing slight compression as AMD's chips gain traction, or as a few